Okay, this is chapter 3, I believe video number 4. We're going to talk about adjusting entries for depreciation, and we're going to talk a little bit about fixed assets. So assets that a company owns that they are using for more than 1 year, so a long period of time is how we define it, a non-current or long-term asset, is usually a fixed asset. It's usually a physical resource that's owned and used by a business and are permanent or have a very long life. So examples of this would be buildings, land, computers, parking lots, office furniture, vehicles, even office improvements, carpeting, walls. You could go. It depends that you can be detailed or kind of larger about this. But either way, it's all assets that are purchased for use in the business and are used for more than 1 year. So what happens is if we spend money on that, it doesn't make any sense from an accounting perspective. If I'm going to be using it for a long time, to only allocate all the money I spent in the year that I bought it. So let's say I buy a vehicle for $25,000. Okay. Does it make sense that, and I say when it makes sense, I mean, from an accounting perspective, does it make sense that all $25,000 of that purchase price should all go in the year that I bought it? Am I only going to use it a year? Probably not. Probably definitely not. So instead, what depreciation does, the idea behind depreciation is as I use that asset and as I use it up, I spread the cost out over what we call its useful life. Okay, now the good news is right now, we are not going to have to calculate useful life and depreciable cost and depreciation. Instead, right now, we're just talking about what it is, what it means. We have a few chapters from now, we will be doing depreciation methods. We will figure out what methods to use, how to calculate what the depreciation amount is. For now, you just kind of need to understand what it is and what it's all about. So effectively, what I'm trying to do is I'm trying to take that money that I spent and spread it out over the amount of time that I use it. Because if I'm earning revenues from it, the matching principle says I'm earning revenues from a depreciable asset, and I should match up the expenses of that asset with the revenues that it is earning. The expense incurred matches up with the revenues earned. So depreciation represents a decrease in usefulness of a fixed asset over time. Notice it doesn't say fair market value. It could have something that changes in value in a positive way, like land. Well, land doesn't appreciate. A building could appreciate over time if it's in a part of town that wasn't very commercial and then becomes really commercial, and a lot of people are moving there and trying to buy property there. A building could be worth more, but we don't care about that. We're talking about the usefulness of something, how much I'm going to use it, and how much as a business I'm going to get usefulness out of it. So generally speaking, we have less usefulness left after we've started using it. So let's say a vehicle, for example, on average, let's say for our company, it lasts us 5 years, and we get 5 years of use out of it. We want to evenly spread the purchase price of that vehicle out over the next 5 years. And that's what this adjusting entry is going to do. The other good news about this, the two pieces of good news, we're not calculating it yet, and the journal entry is always the same. Okay, so we don't have a change in our journal entries. It's always the same two accounts, and it's always the same direction. So we have depreciation expense. Depreciation expense represents the amount of cost used up in this time frame. Okay, so however how much the time frame is, could be a month, could be a year, whatever use I've gotten out of it. This is how much of that fixed asset I have used up. The other side of this is called accumulated depreciation. Because we leave our assets on the books at the full historical cost, what we paid for it, we accumulate all these depreciation expenses over the years into one single contra asset account that is called accumulated depreciation. Now, a contra asset account, just kind of like it sounds, contra being the opposite, and asset being, we know what assets are, hopefully things I own, is handled in the opposite way of assets, meaning an accumulated depreciation account increases with a credit and decreases with a debit. The opposite. We accumulate all depreciation so that the balance sheet has both the original cost as well as how much usefulness of the assets have been used throughout the life of the asset. This is a contra asset account. Like I said, the good news is every time you have depreciation entry, it's always the same. We're not calculating it yet, so they'll say something like, you have $500 worth of depreciation. I'm always going to debit depreciation expense, increase the expense, and credit accumulated depreciation. But another important point they make here to kind of show how this changes the value on our balance sheet is effectively, since the contra asset is the opposite direction of the asset, we net or subtract those two from one another to find the book value. So, for example, my example I gave up here, if I had a purchase price of 25,000, let's say I used up $12,000 worth of depreciation expense. Actually, let's use accumulated depreciation because it'd be more than 1 year. Accumulated depreciation, then the book value would be the purchase price or the cost minus the accumulated depreciation, and this would be my book value. So what that shows is that the vehicle only has $13,000 worth of usefulness left in, based on my estimates, based on my calculations, that I'm only going to get $13,000 worth of use from that vehicle from this point forward. So that's depreciation. The entry is always the same. And I think I'll have one more video for this chapter and be done with chapter 3.